Hey guys, Chad Larson, MLD Wealth. It's October 2022. It's our monthly market commentary and lots to get through today. I'll try to rush through some of the more benign parts, but as always, feel free to give me a call or anyone member of MLD Wealth if you have any questions or comments. I hope you enjoy. Kicking things off with hopefully a little bit of humor. And again, all these slides will be made available in the send out, but there's a funny little cartoon. I'm your investment statement. Someone's dressed up as investor statements going Halloweening, and it's not far off. The macro backdrop in the market currently is terrible. So as we enter October, I'm reminded of a quote from Mark Twain. October, this is one of the particularly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. So a little making light, but you have heard me talk over the last number of months, especially through the summer, as we've raised a significant amount of cash across client portfolios, that we felt October was setting the stage to retest the market lows that we saw in June. And we got it right again. So kind of diving in, a couple of things that are maybe non-financial metrics, but there's the psychology of investing, there's the academics of investing, there's the practice of investing, and all of these things. But listen, this is I wanted to set the table. Last week joins only 4 other times in the last 35 years where 60% of respondents to the survey responded to being despondent. So despondent is one level below despair. People are worried. And I think rightfully so and wrongfully so. But shockingly, this is actually a very bullish indicator. Overlaying when everyone's ready to throw in the towel, when everyone thinks it can't get worse, generally the worst is over. Okay. So after these other 4 periods in history, 1-year returns after this, plus 22, plus 31, plus 7, plus 56. When people are panicking is generally the moment of the most financial opportunity. So high degree of pessimism, high degree of opportunity. To the inverse, when there's a high degree of excitement, generally there's a lot of risks in the market, but people are worried. So that to me is a bullish indicator. We're also well positioned. We've got bullets in the chamber, so to speak, ready to take advantage of that. Sue and I kind of went back and forth a little bit, whether I put this in or not to be overly granular, but again, this is a very bullish indicator. This is last Friday, more than 33 million puts traded on Friday. What that means is the highest single day of put volume since data began collecting over 30 years ago. So this is a rush to hedge. The worst has happened, and yet people finally are running out trying to buy. A put contract is the ability to sell at this price in the future. So people are freaking out, running to protect that's already gone down. Actually, the cost to insure a portfolio today is so outsized that there's quite frankly no economic reason to justify doing it. But again, the herd's kind of doing the things at the wrong periods of time, but as they're emotionally panicking. Next is taking a step back. Okay, like this, as an investor, the risks in the long run are asymmetric. They favor you as the investor. For perspective, even with corrections, an investor in the S&P is up significantly over the last 10 years. Now, if you hyper focus on this last piece, it hasn't been fun. If you were here, you've had fun. If you were here, you didn't have fun. The further you step away, the smoothness of the chart. Now, if you zoom in to this on a day-by-day basis, you can be whipsawed out of the market. But I just really wanted to kind of recommit that the more you're anchored in process and philosophy and less on the daily fluctuations, the easier this gets. Now, listen, this is a great chart. Bulls are built on the shoulders of bears. Below, you're going to see that returns delivered after experiencing bear markets, the odds are in your favor. This is a bear market. The S&P is down a shade off of 25% and over 30 on the NASDAQ. That's a quarter and a third of the largest market in the world. This is absolutely very material. And I don't like making the analogies, but if you're a gambler and you play any blackjack, if you're shown a 10 and the dealer's showing a 6, you double down. You might have just lost the last 4 hands and you feel like you don't want to do it, but what the book says, you double down. So don't wait to, and this is going back to 1956 all the way to 2020. Like after the '07 crash, a great financial crisis, the markets were down 57. They surged 400% off the back of that. 2020, during the pandemic, markets were down 34% and then surged back 113. Every single one of these, you will see that the upside is larger than the downside. This is not the time to panic. This is not the time to tap out. So don't wait to get into a market after a correction. Bull markets are often very front loaded, and timing the best and the worst days, it can almost be impossible because they happen so close together. We've been looking for this capitulation trade. We've been saying for months the market is trying to find a bottom. We've bounced off of them, but the bottom would be defined when the Fed looks to kind of change their cadence and change their tunes. Now, last week, Jerome Powell at the Fed definitely committed and doubled down on his commitment that interest rates are going to have to stay high, and there's room for interest rates to even go even higher. So it's not over yet, but the damage is done. The worst is likely over. Back to this, the best and worst trading days, they happen so close together. So 20 best trades, 9 occurred in years with negative total returns. And the 20 worst trading days, 11 occurred in years with positive returns. These things happen tied together. So while no market seems to repeat, there is a trend. The market predominantly recovers before the bad news is over. And this is so critical. I've been saying this and I'll continue to say it. It will be, the market is a forward-looking vehicle. It's looking forward next quarter, 6 months, 1 year, 2 years out, etc. So while we haven't even seen the damage, you call it, to the news cycle, of rising interest rates and a slowing economy, job loss, etc., housing prices correcting, while that is all peaking, the market will be surging forward. So looking at all these charts, in all cases but one, the market started to recover before peak unemployment and the end of the recession. So don't wait for good news to invest, or you're going to miss out on a very big chunk of that recovery. So again, it will be the hardest thing to do. And even myself as a professional, you question your existentialness over the weekend probably, and this is I guess an ad lib share. This weekend, I never spent more time with industry professionals, capital markets partners, sophisticated investors, traders, hedge fund managers, portfolio managers, all through the weekend, calling, just re-questioning, what's going on in the market. And so even when the best feel the worst, you can tell you that we're starting to get that. So I think that capitulation moment is around the corner. So I'm not calling the bottom yet, but we're well on our way. This is really important. These are bear market decisions. I even, give a shout out to my mom. She came and saw me. But when mom's worried, it means all of you are worried. She said, things are down. These are quite obvious observations. Should we go to cash? Should we just buy GICs? What should we do? And after just kind of walking through very basic economic principles and where we're at in the cycle, the conversation very quickly went from, oh my God, maybe we should just sit and go to cash now, I can't take any more, to, oh my gosh, I actually have some cash over here, we should be buying. So this is the decision-making component that I hope good advice gives better outcomes for private clients. But in bear market decisions, January 1st, 1973. So the value of $1 million invested, in January 1st, 1973, 3 months later, down 950, 6 months, down even more, 9 months later, down, 12 months later, 1 year, 9 months, you turn your $1 million into 500 grand. Whoops. So at what point do you think most investors would have given up and thrown in the towel? So 573, after just the absolute beating that you would have taken in the marketplace, down 43%. That 573,000 removed from the market and reinvested in interest rate bearing deposits at 5%. 6 months later, 12 months later, 2 years, 5 years, 10 years, 10 years later, not back to where you started from. Now, what would happen if you kept that $573,000 invested in the S&P instead of going to cash? 6 months later, that 570K is 771, 792. 2 years later, $1 million. 5 years later, 1.2 million. 10 years later, 2.4. So this is just food for thought to understand that after events like this in the marketplace, now we're well positioned. Our core portfolios are hoarding the highest levels of cash they have even than during the pandemic. We've got a lot of liquidity to take advantage of this. But for you and yours close to you, if you're caught fully invested right now, just don't panic. Welcome to October. Again, I've been talking about this for months that we really thought we would retest these lows. Welcome to October. Major markets bottom, more major market bottoms have occurred in October than any other month. Generally, midterm election cycle, terrible for markets. October, terrible for markets. So major S&P lows since 1932 by calendar month. Shout out to my Jewish friends, sell Rosh Hashanah and buy Yom Kippur. It's something that is part of the investment strategy, rotationally through seasons. So the major low, the 18-month low, you can see the bulk of them happen in October. So again, reconfirmation, everything from tea leaf reading to fundamentals to technicals to gut feeling and experience. October is going to be bad, and so we were prepared for it. Next, this is the 9th time since 1950 that the S&P 500 is down 25% or worse. So these things happen. So it could always get worse before it gets better. I'm not calling the bottom, but historical returns from being down 25% are pretty good 1, 3, 5, 10 years out. So taking a look at this through 1961, 68, 73, 80, all of these, many of these we've been through, many of these, some investors haven't. But these are the big declines, average decline almost minus 37. We're at 25 now. 1 year out, all but one positive. In 1 year, strong returns. Now we could be like the 2000s now, like the dot-com bubble. None of these companies had real earnings. They were just these wild valuations based on nothing. But when you're really looking at the consensus across the 9 other times this has happened since 950, 1 year out returns 21, 30, then 3 years 36%, 5 years 83%, 10 years 200%. All we can say here is that after significant market events, there's incredible opportunity. So stay with it. How bad is it? Listen, things that are going on globally, and I'm going to make some assumptions here. Dare me. Everyone's got a roof over their head that I'm talking to, and God willing, and is okay feeding themselves. And so I'm not going to talk about things that don't matter, but they do. But from an economic standpoint, from a price reaction to the stock market, year to date total return of the S&P, this blue line is about like here right now. This is on trend for almost as bad year to date. 1931, in the midst of the Great Depression, where the markets were down even further. This is the regular dispersion across the S&P for all recorded years. And the best 1 year return and the worst 1 year. This year's been bad. The worst of it's happened. So time to pick up and move forward. This is starting to get a little geeky, but it's important to me, and I'll try to get through it. But the GFSI, the Global Financial Stress Index, which tracks risks, hedging demand, investor risk appetite, this indicator is now at the highest level since the pandemic. Remember, during the pandemic, this is where people thought they were going to die if they went to a grocery store, and that we were going to go through the Spanish flu and 10% of the world population was going to drop dead. That obviously didn't happen, but I can tell you people's sentiment and fear right now is absolutely off the charts. So cross-asset contagion, global market risk monitor reaches pandemic high. This is when you can't hide from it, when we're seeing stress in the credit markets, credit freezing, capitulation in the equity markets, margin calls, like all of these types of things happening. Again, bullish sentiment because life goes on. And like, to put it into perspective on size, we've just had $58 trillion drawdown in U.S. stocks and fixed income market value. Now, what's to cause this? Like, again, I'm not going to be politicized. It's not all, you can't blame it all on Putin. You can't blame it all on overstimulating the market. You can't blame it on people have just reacted and freaked out. There was a lot of easy money in the system, and listen, there was some asset bubbles and things needed to come down. But from a broader sense, when we see deep value, liquidity at any price, trading going on, things that are better businesses today during even an environment like this, we're seeing those stocks being hit. It's just people are just completely capitulating. So just go ahead and put it into perspective how significant of a drawdown this has been. That's kind of the basis of the whole kind of run through. I'm so very proud of kind of the year-to-date performance of the core fund that I manage, and the positioning strategies that the team has been consistent in delivering. I think a lot of what we do is kind of like being a personal trainer. I think everybody knows how to stay in shape or how to work out, but do they actually do the work? Do they actually put the time in the gym? Do they eat all their veggies and drink all the water and get lots of rest and do all the things? So our job is to be on behalf of our private clients, so we can thank you for the opportunity to help you navigate challenging times like this. But we're putting into practice. I'm happy to jump on any direct calls one-on-one, but we have incredible amount of liquidity across the portfolios. We've been tactical. A lot of changes across the portfolios, even in the last week of the month. Anything that was mark to market down on, rotationally we're trading through it. You have to trade your apples for apples here and reset not so much the cost base from a perception standpoint, but we paid tax in the last couple of years, so we're crystallizing, we're being proactive and being able to carry back losses going forward, but making sure that we keep that beta, we keep that market exposure, and that we're here and we're ready. I don't know exactly when that signal is going to be to go, because a lot of you have called me and we are prepared. I've never spent this much time with my hit list, so to speak, but of cash on the sidelines, waiting and ready to start aggressively taking advantage of opportunity. That moment hasn't come, but I will say as of right now, my plan and the team's plan is to start programmatically with process and discipline, starting to deploy capitals back into the marketplace, because the values that we've seen are, I believe, once in a market cycle. As always, thank you for your time. If you have any questions, comments, please feel free to give myself or any member of the team a call. Have a wonderful day and all the best to you guys. Cheers.